Mr. Chairman, thanks very much for the introduction. I'm very pleased to be in front of such a prominent audience in yet another time. I'd like to share my thoughts on the effectiveness of financial technology in retail distribution. Before doing so, I'd like to show you a video demonstrating effectively that. You'll see one of our two founding principals, Melinda here, presenting a live launch of a transaction and selling that in front of an audience in New York. So if we can please play that video, thank you.
So obviously this is real time happening at 4 p.m. Eastern time. What you see here is our platform and what we're launching at 4 o'clock is an investment in our art finance business. So $10.5 million investment, you can see 100% of it is remaining. It's going to launch in about 2 minutes and we will see what happens. So there you go.
With that, what does that mean? What are the key benefits to our borrowers? I'd like to share a few thoughts there, and then moving on benefits to the investor, and concluding on how do we do it and how do we make this work in the marine financing space. So one of the obvious benefits in utilizing financial technology in retail distribution is accessing masses of retail investors and essentially reaching out to an inexhaustible pool of capital. So within YieldStreet, we've got 200,000 subscribers who look at our offerings in a number of sectors, including real estate, commercial financing, litigation financing, art financing, and more recently, in the last 1.5 years, in ship financing as well. Those 200,000 investors merely represent 1.5% of the overall US accredited investor retail space. So that one amounts to 14 million people that possess about 20 trillion US dollars in liquid wealth. So as you can imagine, if 200,000 investors look at our projects, they sell at 16 seconds for 11.5 million, then you can imagine the breadth and the power of accessing that capital through financial technology. Another advantage is that the capital is of diverse risk appetite. So what financial technology can do, therefore in the benefit of the borrowers, is there is enough data to risk profile investors and do the same at the other end of the equation, which is the transactions in the maritime space, and create a close enough match for any different transaction in finding each audience. So higher, lower loan to value, older, mid-aged vessels, flexible, structured or not, employment in place, etc., all of that have a match, so to say a perfect match, which is accessible through financial technology. So there are efficiencies there, and that comes to the benefit of course, of both the investor and the borrower. That comes also with the advantage of, if need be, there can be an efficient risk-reward or pricing model utilizing existing data. The third obvious advantage to borrowers in utilizing financial technology is that administration costs when it comes to managing a transaction, managing thousands of investors are really low. Not to be confused, the cost of funding is not low. That depends on the appetite of the underlying investor. But the point is that managing thousands of investors, making distributions to them, collecting their capital, reporting to them, communicating with them can only be made possible with financial technology, and keeping that part of the cost function as low as possible. Of course, imagine if you were to administer 400 investors in a single offering, or 1,000, or more than that in a 10 million marine financing loan, how many people you would need to deploy to achieve that. Not the case with financial technology. So turning to the benefits of fintech for the investor, that really is one key aspect, which is granting access to thousands of people or millions, and allowing them to consider a number of asset-backed senior secured loans that we offer that previously were unavailable to most and were really only available to institutional investors or ultra high net worth individuals. So what is it really? How do we make this work at YieldStreet? We are originating transactions in the maritime space, so we speak to people, we are out in the streets meeting, utilizing our existing relationships with our team is based in Athens and comprises of professionals that have been around for actually the entirety of our careers, servicing the ship financing space. So we originate those transactions, we structure those transactions, and when we feel comfortable, propose those to our principals. When these are approved, we fund those transactions through our own capital resources, through YieldStreet's capital resources, and subsequently, like a week after, 10 days after, we utilize our webpage and our technology to show those loans to our investor base, retail investor base, and allow them to consider and take a small or a larger slice in those senior secured loans. So up until recently, we've been introducing to our investors our marine and other offerings on a transaction per transaction basis. Since last week, we are now very proud to announce a major cooperation with BlackRock. BlackRock is the world's largest fund manager. They manage more than 7 trillion in assets. And so that cooperation allows our investor base to place their funds not just on a transaction per transaction basis, but rather on a pool of investments, or a pool of investments that are created jointly by BlackRock and by YieldStreet. So BlackRock bringing along the more liquid asset types, and then YieldStreet the more illiquid asset-backed investments in the asset classes I mentioned earlier. So the benefit in that for the investor is, of course, that they get access to diversification. And the benefit for the borrower, for the marine borrower, is that they continue to tap on that inexhaustible pool of capital. I'm going to close my short presentation by setting out what we think are our key strengths within the marine financing space. These are that we provide flexible capital. We are prepared to consider higher loan advances if need be. and for the right counterparties, we are prepared to transact with mid-aged or older vessels, and we are fast and efficient. We do possess a physical presence in Athens, which is in very close proximity to Cyprus, and we are happy that we service this industry with a combined wealth of knowledge and expertise of many, many years shared across our team members. Our team is complemented with the presence of our managing director, George Kambanis, who has been in the business for decades and knows very well the space and the parties involved. I'd like to thank you for your attention and open the floor to comments, questions, now and later.
Thanks so much for your presentation. One thing I want to ask is that can you just, in a broad brush figure, just try to put in a basic form what you perceive as being the definite difference between alternative modes of finance and conventional finance? Would you like to clarify in a nutshell where you look at it, where you see it?
Sure. In my mind, alternative finance is essentially what constitutes senior secured non-bank finance beyond the traditional bank terms territory. So that typically implies capital flexibility, implies in certain occasions elevated loan advances, so bringing and adding value for our or for that part of the ship owners that recognize that flexibility and wanting to deploy lesser capital in their financing structure. That can be neither a form of mezzanine financing or senior secured at a higher advance. And to some extent, a number of players, including YieldStreet, also having the ability and the appetite to engage with older vessels.
Tell me, on that particular basis, in terms of costing, I mean, that's the main prerequisite, because, I mean, usually mezzanine finance comes as literally, in an ordinary layman's language, it's a colourful way of increasing leverage from conventional, let's say, 50%, 60% levels to give something substantially more, and that's why they call it mezzanine finance. But that usually comes with a lot of restrictions, a lot of prohibitive costs. Could you actually enumerate more or less what they would be?
Yes, well, the cost structure is clearly higher than those of banks, and that is anything within 6-7% all-inclusive to 11-12% per annum. Our bracket is in the higher end of that because we allow for advances that are typically on the elevated side of the spectrum, so 75%, in certain occasions a bit higher. So the idea here is that we get customers to recognize the added value and the difference compared to the bank product, and hopefully in recognition of that added value, be prepared to pay for that elevated advance. And let's not kid ourselves, but anything beyond perhaps 60% in ship financing, which is a very highly volatile business, basically constitutes semi-equity. So that needs to be priced accordingly.
One last question, and then this anything for the floor, is that on an ethical grounds, if I may use that word in the shipping conference, on ethical grounds, do you particularly think that sometimes alternative finance can go on the verge of breaching the code of ethics by suggesting that an owner who may be enthusiastic about making an investment, whatever, maybe overextending himself in doing something which is commercially not viable? I mean, I know that it's free world and ship owners are entitled to do what they want and buy when they want and borrow what they want. But from the banker's perspective, when you find these exorbitant costs, which you refer to, would there be maybe the underlying suggestion that the bank, when you talk about that kind of mezzanine finance, that perhaps they should put more importance on telling the owner to be cautious and not go ahead with the project? Because it seems that you're inducing an owner to go on a rather marginal footing where things may go for easily may go wrong.
our endeavor is not to produce senior loans at the risk of the investor base that would destroy our reputation. So we are cautious more than anyone else in committing to those. The way we work in this space is for anyone that is prepared to pay that elevated advance, we need to get comfortable, first of all, with that counterparty, and second of all, in demonstrating to us how he will make money before us so that we can get paid. And in certain situations that we've engaged last year, financing large ship owners who took that financing cost, is that they exploited a certain opportunity, be it taking out a bank at a discount or refinancing vessels that were no longer attractive for conventional banks. So a certain situation that makes money for that owner beyond the classic owning a vessel, running it for certain years and exiting.
Thank you. Is there any more questions from the floor? Anybody wants to ask anything? Any suggestions? Well, anyway, thanks very much.